Deepesh Pandey, Head Investments at IIFL Capital. Deepesh, hi, morning. How are you mapping the Indian market environment right now? Lots of key data points. You've got the Q4 numbers, which is slated to come out, Infosys on Friday. You've got the credit policy as well. And then, of course, government intervention in every possible sector.
I think it will be a very interesting next few days. As you said earlier, there is Q4 results starting with the Infosys guidance on 12th April. There is a very important monetary policy meet, and I think that's a very important trigger which investors are looking at in terms of what RBI does on rate cuts or in terms of CRR cut. So I think it's very interesting next few days. We have a short-term trigger for the market coming up. Let's see how it works out.
Morning, Deepesh. Nikunj Dalmia also joining in from the Mumbai studio. Deepesh, 12% is what Indian markets gained in Q4. What is your opinion when it comes to Q1 FY13?
Nikunj, it's very difficult to estimate what will happen in a quarter. At best one can talk about what should possibly happen over the next 12 to 18 months. I think market upside will be linked to earnings growth, which we would see over the next 12 months. I don't see any scope for re-rating considering the outlook in terms of interest rates and the policy environment in general and the uncertainty about foreign flows. I would think possibly if one is talking about 10 to 15% earnings growth, that is the kind of upside one could see. But obviously these things don't happen in a linear fashion, so we saw a very strong first quarter. Possibly Q2 will be weak, and hopefully by year end, fiscal year end, market should again pick up. So that's the kind of upside I'm looking at in line with earnings growth. Nothing very exciting.
Deepesh, three factors which are driving global markets this year are A, global liquidity, B, strong US economic data, C, weakness in dollar. But all the three factors currently are not favorable. Global liquidity has reversed, dollar has exhibited some strength, and of late US economic data has been quite mixed.
Yes, I would agree, and that's why you're seeing foreign flows a bit subdued over the last few days, and I think a lot is also to do with this uncertainty about Mauritius and other tax havens for routing foreign investments into India. That's also obviously impacting foreign flows, but I think yes, considering the developments particularly also in India over last 1 month, it's quite logical that foreign flows have slowed down.
So Deepesh, what is it that you're expecting from the central bank this time around? Does it seem like a 25 bips cut, if at all it were to happen, could actually lift the market and put us back in the green?
I doubt if a 25 basis point cut will really help market in a big way. Investors typically will have expectations over a period of time. They would look at what will happen over the next 6 to 12 months. And their expectations in terms of rate cut have substantially come down from market participants talking about 100 to 150 basis point cut. Expectations range from 50 to 75 basis cut over next 12 months. So what will happen immediately is some kind of a trigger, but I think in terms of expectations going ahead for 6 to 12 months, those have really come down quite sharply post budget and post what's happening to crude oil prices and considering and the inflation outlook. So I think that is one factor which has which will kind of remain as an overhang. You need stronger rate cuts, possibly to revive, investment activity and also to improve profitability for some of the heavily, over-leveraged sectors, which may not happen. I think cost of funds possibly would remain high, considering also that there is acute liquidity crunch at the short end right now. So while RBI rate cuts will be one factor, but overall direction of interest rates will move down much lesser now versus what was expected over next 12 months. So this will remain an overhang, and this was supposed to be one trigger, but I think this will be much more moderate now.
Deepesh, I don't know if you've had a chance to look at it, but the PNGRB has directed gas utility companies, in particular names like IGL, to reduce the CNG as well as PNG tariffs. How do you think the market is going to read into this? Because the stocks are falling like 9 pins right now. IGL is down almost about 40%, and the entire sector is seeing somewhat of a knee-jerk reaction.
I think this was expected for some time, but clearly the magnitude of this cut has taken everybody by surprise. And I think obviously market doesn't like such huge cuts and uncertainty in terms of profitability. We've also seen this as an overhang on other sectors, including metals, where there could be there could be mining tax coming up, which will take away a substantial part of profits of these companies. So, quite a few sectors have this overhang going ahead, and we have already seen this happening in case of gas sector. So they should further, reduce confidence in some of these sectors where there is this overhang, including in metals, where there's a mining tax, and obviously I think what has happened in gas sector has been much more than what investors initially expected. Therefore, the reaction to stock prices has been quite severe. I think it'll impact all stocks, in that sector, and that's what we are seeing today.
Dipesh, do you worry about investing in PSU stocks? First it was ONGC, then it was Coal India, now it is IGL.
I think IGL problems are not specifically linked to being government owned. It's a sector which is supposed to be regulated, and therefore it has been brought under these regulations. In general, government-owned companies or public sector companies span across sectors. There are some sectors where they have very strong positions, where they really are mostly beyond, regulatory overhang or government intervention, including, government-owned banks. And then you have companies in oil and gas sector, which face the maximum brunt of government intervention. So I would still think that you got to differentiate. You got to stay away from companies, which are vulnerable to government intervention, or which are vulnerable to subsidies or profit share, etc. But I wouldn't generalize, that all the companies. There are some very, very strong companies in the sector, and some of them also derive that position from being monopolies in their respective segments, or having access to a huge resource base. So you got to differentiate, but in general, yes, I think investors will be much more wary going ahead, considering what's happened specifically in oil and gas sector and coal sector. But I would tend to differentiate across various segments in government-owned companies.
Dipesh, good to have you on the show. Appreciate you taking the time out and joining us today on ET Now.